The next two policy meetings will be watched closely. We've got one taking place on October 28th and 29th, and the ending of the year one at December 9th and 10th. We are expecting more cuts there. Joining me now is the Wall Street Journal's chief economics correspondent, Nick Timiraos. Nick, great to see you. Thank you so much for being here. What was your main takeaway from Jay Powell's speech after the cut yesterday?
Well, Maria, thanks for having me. You know, the big question, as you noted, was whether a majority of the committee would write down two more cuts this year or just one more. The September projections are kind of weird, right? Because it's calendar-based. You're writing down really what you think you're going to do at the next two meetings. So it was significant that Powell had a majority writing down cuts, consecutive cuts here at the last two meetings. And what I found most interesting from Powell's remarks in the press conference, he was asked, well, if the labor market's slowing and that's why you're doing this, why are 25 basis points really going to matter? And he said he sort of accepted the premise that they wouldn't matter. He said what really matters is the path that the market has priced in, and we are validating that path, essentially. So he went further than he had to there by blessing the market's pricing for cuts in October and December. He called it a risk management cut, which the market didn't like. But frankly, if the economy does not look like it's outright going into a recession, then that is the reason that you would cut interest rates. It's a risk management exercise because you want to make sure the economy doesn't go into a recession.
And what about that impact, Nick? I mean, if you're talking about 2 to 3 cuts, what would be your expectation in terms of the impact on longer-term rates and the impact on the housing market?
Well, so we've seen mortgage rates come down a little bit after the sort of lackluster August employment report. And I think what it's going to take here, you know, the analysts I talked to, what would it take to see lower yields? You'd have to see sort of more rotten data on the economy. Right now, the market is anticipating that the terminal rate, or the point at which the Fed stops cutting interest rates next year, is just below 3%. And so what is going to have to happen to get interest rates lower is weaker growth, weaker activity, something that tells you that the Fed is going to have to cut to a lower level than, you know, 2.8 or 2.9%. And until then, if the economy rallies here and these cuts are able to sort of stabilize the labor market again the same way that they did last year, then it's possible you don't see interest rates come down quite as much as would otherwise be the case if the economy is really slowing.
What's your expectation for growth, Nick? I mean, here we have this morning President Trump in the UK announcing a deal to help the U.S. and the UK dominate AI. You've got a huge deal with NVIDIA. Of course, top story in the Journal this morning, investing $5 billion in Intel, where Intel will build NVIDIA's custom x86 chips. NVIDIA will integrate it into its AI infrastructure. Intel stock is up 28% right now. Incorporate all of that together for us, Nick, in your expectation for growth in the economy overall, because some people would argue that this is a different kind of economic story unfolding given the dominance and strength and participation of AI.
It's a great point, Maria. I think the question here is, you know, which forces in the economy are going to win out right now. You see a cooling labor market. You see a housing market that's frozen, waiting to thaw here if mortgage rates come down. And then you do have this AI data center, hyper investment story on the other side, and that has been evident in the stock market for a while. So which of these forces win out? If income growth slows, does consumer spending come down? That would argue for more cuts. The other side of the argument is the economy is going to pick back up here, and so maybe you don't have to cut as much. And I thought the projections yesterday, Maria, that the Fed officials put out were notable because even though a narrow majority projected 2 more interest rate cuts, you had 7 of the 19 participants who didn't have any more cuts this year. So this is a divided committee. It is not at all clear, what they're going to be able to do beyond December, or maybe even in December if the economy shows more strength here, the strength that you see in the stock market and that the president was just talking about.
Yeah, and you wrote this morning that it tells you, well, you noted the lack of more dissent being notable, that it tells you there's probably more deference to the Fed chair right now.
Right. You have this political confrontation between the White House and the administration. You have these Fed presidents, some of them, who are more concerned about inflation. And a lot of people I talk to say, well, wait a minute. Why is everybody so worried about inflation? We've gone through this big spike. It's come back down.
Right.
You know, I have young kids, Maria. If I don't enforce bedtime every night, then my kids are going to think they can keep staying up late. And it's a little bit like that with inflation. If you allow higher inflation to persist, then consumers are just going to think, well, I have to accept these higher prices. And that's how businesses continue to get away with price increases.
Yeah, great analysis there, Nick, with the kids. Love it. Great to see you. Thank you.
Thank you for having me, Maria.
Nick Timiraos, always a pleasure.